Well, it's back to foreign currency, of course. This is the third of the recordings I am giving you on Forex, on foreign exchange. We've looked at foreign transactions and we've looked at foreign subsidiaries. And we've seen that, by and large, foreign subsidiaries is fine. By and large, foreign transactions are fine. But what is difficult is the exam questions in this area, where parent buys the sub, and obviously the sub is a foreign sub, and that creates a problem in itself, but also the parent trades with the subsidiary and the parent lends to the subsidiary, and therefore you end up with foreign transactions and foreign subsidiary, and that makes questions challenging. Speaking of questions, the question I'm going to focus on for this recording is called Xenon. And I've got a copy of it here. So here's my copy of Xenon. So find yourself Xenon. It's Xenon. And if you're wondering what that is, I believe it's the, what do they call it? The noble gas that lives inside modern headlights, apparently. So there you go, Xenon. Take a look at the requirements, which appear on probably the third page of the question. The requirements are: A, prepare the income statement and statement of financial position for the group for the year, and B, prepare a movement in consolidated reserves for the current year. As you may remember from the previous recording, doing Part B is very challenging, but doing Part B is also by and large completely unrewarding, because the movement on reserves is very, 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 very rarely examined, almost to the point where I sometimes think of removing Part B from this question altogether and just ignoring it. It has been examined, so I've left it in the requirements, but I do not propose to record me working my way through that process yet again. I think the danger is, if I spend too long on Part B, you'll end up with a disproportionate emphasis on Part B. Part B is difficult. You'll tend to focus on it a bit much, and that'll be to the detriment of Part A. It's Part A that gets examined. The truth is, we never really see these, very rarely see these days questions which are both income statement and balance sheet, but of course what they are is income statement or balance sheet. And, you know, pretty much every examination has got either an income statement or a balance sheet. And for that reason, obviously, I should be focusing on Part A. So I'm going to focus on Part A. So I'm going to focus on Part A. So if you wish to work Part B and you wish to have a look at it, you don't have to, but if you do wish to have a look at it, there's answers in the back of the class notes. Of course there is. Right, okay, so we're going to be doing Part A. And I've got to make sure I stick to my 1 hour, haven't I? Which is easy enough when I'm in a classroom and students are kind of looking at their watches and their tummies are grumbling and they're ready for their next break by an hour. But this isn't the classroom, this is the dungeon down in London, in Holborn. And my watch is upside down, that doesn't really help. So according to my watch, in frosty London, it is now 4:10, and therefore I know what time I've got to finish. Right, okay, off we go. Xenon owns 60% of Gallium, a company situated in a foreign country. The currency of this country is the Kram. X acquired G at the beginning of the year, on the 1st of January. The group's policy is to value the non-controlling interest at fair value. The fair value of the NCI at acquisition was 1,466 million crams at acquisition, which is the first day of the year. Well, 60% is enough to give you control. It gives a 40% NCI, and that's about it, really. Perhaps reinforced that the first day of the year is also the day of the acquisition, the day of the purchase of the subsidiary. Yeah. You've got an income statement with a reserve movement, which is quite nice. You don't always have a reserve movement attached to income statements, but it's helpful when you do. let's have a work through the income statement. It's the usual income statement with operating, financing and tax. But can you see at the bottom of the income statement, G has got an extraordinary item. Now this is a classic, and I think quite clever, exam point that the examiner often introduces into foreign subsidiaries. What he would like you to imagine is the foreign subsidiary is in a country that not only has a different currency, but also has different ways of doing financial reporting. Now, extraordinary items are banned under international financial reporting standards. You effectively can't have them. So extraordinary items are usually classified as super exceptionals, or at least they're moved further up the income statement under international financial reporting. So that 200, we've got to get rid of it. Exactly where it goes, we'll find out when we turn over the page. But that 200 for the extraordinary item, it can't stay, because extraordinary items are banned by international financial reporting standards. The other thing to say about the income statement is, have you noticed that G is paying a dividend? Well, that's actually the reserve movement. G is paying a dividend of 800. Did you spot that? And that X is receiving a dividend of 60. Can you see that on X's income statement? So X is receiving a dividend of 60 and G is paying a dividend of 800. Obviously they're in different currencies, but presumably there's an element of the right hand paying the left hand. And therefore, well, that's going to add a layer of complexity that we're going to have to consider. So that's that. Quite a good introduction to the question. When we turn over the page, it's a bit boring, the balance sheet, frankly. There's not much going on. But there is something that you don't see very often under international financial reporting standards. Can you see how the balance sheet has been presented as assets less liabilities equals equity? Do you see that presentation? That presentation is what's called the equity presentation for financial reporting. And it's not the one that you usually use when you're doing international financial reporting. You usually have, like, I quite like it, the usual way. It's assets equals liabilities, roughly speaking, isn't it? Assets equals equity plus liabilities. And the effect of the normal balance sheet is you don't get any brackets. All the numbers are all raw, as I like to say, and not in brackets. That is the more usual presentation of a balance sheet under international financial reporting standards, but it's not the only presentation. This is another allowable presentation under international financial reporting standards. And I decided to stick with this presentation. This was the original presentation done by the examiner when this question was first examined. And I decided to stick with this presentation because actually this equity presentation is coming back into fashion in international financial reporting, and it's useful to make sure that you are comfortable with it. You don't have to do your own balance sheet this way, but you might be required to discuss different ways of presenting information on the balance sheet. In question 4, for example. We're doing question 1 now, but understanding that the balance sheets can be presented in different ways is useful when working in the B section. Enough said. So here's paragraph 1. The dividends were paid by G at the year end and received by X on that day. That paragraph, of course, is asking you to go back onto the income statement and make some sense of the payments there. Now, if I can just turn over the page and grab my calculator. Where's my trusty Casio? Do you see the 800 on the reserve movement? Well, first of all, 60% of that will go to X, won't it? So 800 multiplied by 0.6 gives you 480. So 480 would have been received by X on the last day of the year. But of course, X would have turned those crams into dollars, and the exchange rates are at the bottom of the second page, at least on my question anyway. Paragraph 6. Where are we now? 31st December. Do you see the rate is 8? So you divide by 8, gives you 60, right? So 60 is the dividends received from G. It's also the dividends received by X, can you see the dividends received by X is 60? So that means all of the dividends received are internal. So if all of the dividends received are internal, how much of the dividends received are from outside? 0. So the group has no dividends received, only transfers internally. So dividends received won't be appearing on my answer, because on the group financial statements, the group doesn't have any dividends received from outside. Paragraph 1, not too bad. Paragraph 2, not so easy. I think it's the hardest paragraph. People tend to struggle with paragraph 3 as well, but I think 2 is really tricky. It's good though, but perhaps a little bit overcomplicated. But this is the original version the examiner, had in his question. I've basically what I did with this question was I took 2 past exam questions and stuck them together to make this sort of, all singing, all dancing exam question. G has applied local GAAP, but has made some attempt to adapt international financial reporting standards. As a result, the subsidiary has written off research previously capitalised as an extraordinary item, prior period adjustment in the sum of 100 million. The remainder of the extraordinary item is the recognition of a fall in value of some plant, and that was damaged during the year. Well, if we go back to the extraordinary item, do you see the extraordinary item is a figure of 200? Do you see that on the income statement? It's a figure of 200. So what 2 elements are in that 200? Well, 100 of it is this prior period adjustment, and the other 100 is the fall in value. Now, how would you normally describe if using the normal language of international financial reporting standards, how would you normally describe a fall in value of some plant that was damaged during the year? The way I would describe that is using the classic phrase, impairment. So the extraordinary item divides into 2 halves. One half goes up the income statement, and I suggest to you, just see the operating expenses of 1,000. It's actually 1 billion, 1,000 million. Do you see the operating expenses of 1,000? I suggest you chuck the impairment of 100 in those. Okay? So you've moved that up. But you've got to get rid of the extraordinary item altogether. Now, dealing with the prior period adjustment is a bit tricky. Let's read that again. G has applied local GAAP, but has made some attempt to adapt international financial reporting standards. As a result, the subsidiary has written off research previously capitalised as an extraordinary item prior period adjustment in the sum of 100 million. Now, the subsidiary had previously capitalised research, which was wrong. They should never have capitalised research. And to adjust for that mistake, they should indeed have put a prior period adjustment, a fundamental error, or a fundamental change of accounting policy, whichever way you want to describe it. A fundamental error is removed by the process of restatement, or by the process of prior period adjustment. Now, do you see what they actually call it? They call it an extraordinary item, prior period adjustment. Now, they almost got it right. Do you see what they did with the 100 for the PPA? They put it against the profit for the tax. They put it against profit after tax for the year. But what you're supposed to do with a prior period adjustment is you're supposed to adjust the prior period figure. So what they've done is they've recognised the prior period adjustment over the year, but they should have recognised it at the year start. Do you see the mistake they made? It's a mistake of at and over. Instead of recognising the prior period adjustment at the year start, they recognised it over the year. So where should the 100 have gone? Well, it shouldn't have gone against the profit after tax of 1,800. It should have gone against the accumulated profits brought forward of 1,200. Do you see the 1,200 at the start of the reserve movement? That 1,200, of course, is 1,200 only because they had the wrong policy of capitalising research. If they'd never capitalised the research, then that figure of 1,200 would have been 1,100, and that's what the figure should have been. So the prior period adjustments should be set off against that 1,200. Okay, that's paragraph 2. Now paragraph 3, which, as I say, some students find even harder than paragraph 2. Now paragraph 3 and 4 are really worth the effort. I don't get quite so excited about paragraph 2 because it hasn't repeated itself frequently in the exam. It has repeated itself, but not frequently. But it seems like every time the examiner has a foreign subsidiary, he has paragraph 3, or he has paragraph 4, or he has both paragraph 3 and 4. So please, put some time in to make sure you are comfortable with paragraph 3 and 4. The start of paragraph 3 is relatively easy. The fair value of the net assets of G at acquisition was 2 million after take. I do apologise, it's paragraph 4 and 5 that I'm talking about that are difficult. The fair value of the net assets of G at acquisition was 2 million after taking into account the removal of the capitalised research discussed above. Goodwill is unimpaired. The increase in the fair value of G over the carrying value is attributable to machines which are depreciated over 5 years on a straight line basis. So what he's done is he's told you that there is a fair value adjustment. How much it is, he hasn't told you. We have to work it out as a balancing figure, and then once we've calculated it, 1/5 of it gets knocked off the balance sheet and goes into the income statement, and therefore 4/5 of it are still on the balance sheet at year end. Right, what I was saying about Forex repeating itself again and again and again, paragraph 4, paragraph 5, spend a lot of time on these two because even though they are tricky, they're worth the effort. During the year, X sold 30 million in goods to G at a margin of 20%. All of the goods have been utilised in production by the year end, but only 1/2 of the relevant finished goods had been sold. G received the goods on the 16th and paid on the 17th. The foreign exchange difference remains in current liabilities. Now, the first bit of this question is relatively easy. Did you notice X sold to G? So it's parent selling to the subsidiary. If the left hand records a sale and the right hand records a purchase, then the left hand is correct to record a sale and the right hand is correct to record a purchase, because there is a sale and a purchase from the individual entity point of view. But from the point of view of the whole group, this is no sale at all, so we've got to strip we've got to strip 30 out of sales and strip 30 out of purchases. That bit's easy. And then there's a PUP, a provision for unrealised profit, a PUP, a PUP, a little baby dog. During the year, X sold 30 million in goods at a margin of 20%. So the amount of hidden profit would be 20% of 30, which is 6. All of the goods had been utilised in production by the year end, but only 1/2 of the relevant finished goods had been sold. So 1/2 is still in stock, so 1/2 of 6 is 3. So there's a PUP of 3. Do you want to do that again? So, not difficult, you just take 30, multiply by 20%, multiply by 1/2. During the year, X sold 30 million in goods to G at a margin of 20%. All of the goods have been utilised in production, but only 1/2 of the relevant finished goods have been sold. So 1/2 of the hidden profit is still in the group and therefore unrealised, and the hidden profit itself is 20% of 30. 20% of 30 is 6, and 1/2 of 6 is 3. It's the parent that's doing the selling to the subsidiary, so it's parent PUP. That bit's easy, isn't it? Or those two bits are easy. The difficult bit is dealing with the Forex. Now you've got to read this very carefully. Do you see it says the foreign exchange difference remains in current liabilities? Now the Forex gain or loss should be in the statement of profit and loss. You know, the Forex gain or loss, the Forex profit or loss should be in the profit and loss account, but it's not in the profit and loss account. It's in the balance sheet in current liabilities, so it's in completely the wrong place. It's a bit annoying this, but can you see that the current liabilities are a figure in G of 1,000? Do you see that with the sausage around it on the right hand side? So the current liabilities are 1,000 in G, and it's telling you that figure's wrong because there's a Forex loss in there that should be on the income statement. But how much is the loss? I don't know, let's work it out. G received the goods on the 16th of June and paid on the 17th of July. Now, what's the currency of the invoice? Do you see it's $30 million? So the currency of the invoice is in dollars. So when G receives the goods, it has a liability of $30 million. And when it pays off the liability, it pays off $30 million. But of course, G doesn't think in dollars. G thinks in its own local currency, which is the kram. So let's work out how much they've lost or gained. It's not difficult. You just got to, look at the dates and pick up the information and work it through. But terrifies most students. Let's hope that's not you. So 30. Can you see the date is the 16th of June? Yeah, for delivery. And the 16th of June has got a rate of 6. Okay. So the kram to $1. So the 6 krams to $1. So times by 6. It feels like, what we actually owe at the point of delivery is $30 million. But when we're thinking of being G, when we take supply from our own parent, we feel like we owe 180 million krams, right? We don't actually owe 180 million krams. We owe $30 million, but, we think in krams. So we feel like we owe 180 million krams. But what do we actually pay 4 weeks later? 17th of July, the rate is 6.5. So 6.5 times by 30 is 195, so we end up paying 195 to our supplier. Our supplier happens to be the parent, but from the point of view of the subsidiary as an individual entity, it's just a foreign supplier. So we end up paying 195 when we thought we owed 180, so we made a loss of 15. That's all it is. Yeah? You thought you owed 180, but you pay 195, you pay 15 more than you thought you were going to pay, so you made a loss. Well, it's your fault, isn't it? I mean, it's the fault of G. If G had paid straight away, it wouldn't have ended up losing the money. It's up to them, wasn't it? So because they ended up speculating, from G's point of view, they ended up speculating in dollars, they ended up losing. They lost. And the figure that they lost is 15. And that Forex, it's in the wrong flipping place, isn't it? Forex loss should be in the profit and loss account, but it's not in the profit and loss account, it's in the balance sheet. But where is it in the balance sheet? Well, it's in current liabilities. How do we know it's in current liabilities? Because it says. It says in the last line, the foreign exchange difference remains in current liabilities. But this is the tricky bit. The loss is a loss, and therefore it's a debit. So this debit is in amongst the creditors. Yeah? And therefore the debit is making the creditors look smaller than they would be if they were at their full height. So to remove the loss, you add back 15. The true trade creditor figure is 1,015. And what we see is 1,000 because 15 has been deducted from it. Ah, now that's the bit you've got to watch. So when you take out a debit from creditors, they return to their full height. Okay? Now, if you're struggling with that, just think of a few little parables. I mean, I'll just do it with, like, my brother. My brother, I measure my brother's height. I measure my brother's height, and he comes out at a height of 160. But the reason he's come out at 160 is because he's got a huge backpack on his back. If you take the backpack on his back, he rises in height by 15. So how tall is he really? Do that again. So I measure his height at 160 centimetres, but the backpack is pushing him down by 15. And when we take the backpack off, he rises by 15. How tall is he really? He's 175. Oh, easy, right? All right, try this. You look in your wallet and you've got... Here's my wallet. Oh, that's cute. You look in your wallet and you find, I've got 1,000 UK pounds. But you know that your wife has borrowed 15 pounds from you. How much money did you have before she borrowed the 15? 1,015. You add it back to find out what the figure used to be. Yeah? Okay. So that figure there of 1,000 which looks like it's correct, is wrong. And when you take the debit out of the creditors, they rise in height to their true height of 1,015. So the current liabilities in G are not 1,000, they're 1,015. Now have a good think about that. Make sure you're okay with that, because this kind of thing happens often in financial reporting, happens a lot in P2. 5, much easier 5, same kind of idea but not exactly the same. X made a loan of 50 million to G immediately after the acquisition on the 1st of January. This is still outstanding at the year end. The parent has recorded the asset in current assets, and the subsidiary has recorded the liability in non-current liabilities of the rate ruling at the year start. Now, the parent has recorded the asset in current assets. So that's the figure of 2,000. Do you see the figure of 2,000? Now, the figure, in that figure of 2,000 is 50. And obviously, if the left hand lends to the right hand, then, you know, the left hand is going to record an asset and the right hand is going to record a liability. But instead of one recording 50 and the other one recording 50, one's going to record 50 and the other one's going to record an equivalent number of crams, right? And that's the complication. But we're looking at the asset now. If there's an asset in there of 50 that shouldn't be there, then we just take the asset out and the assets shrink. It's easy. So 2,000 minus the asset, when we remove the asset from the assets shrink to an external asset of 1950. Now it's much trickier when you're doing the liability, because obviously it's got foreign stuff going on. Now, can you see that it says that the subsidiaries recorded the liability and non-current liabilities at the rate ruling at the year start? Now I know that they should have recorded it at the rate ruling at the year end. But what they should have done and what they did do are obviously different things. So they have recorded it, the rate ruling at the year start. So what is the liability that they've recorded? Well, what was the rate at the year start? Can you see it was 5? So 5 multiplied by 50 gives you 250. And 250 is the liability that's in liabilities that's got to come out of liabilities. So that figure that we're referring to, the problem figure, is non-current liabilities. G has got non-current liabilities of 700, and if you take, if this guy has recorded 250 as a liability to its parent, but it's recorded a total liability of 700, then the external liabilities to owe to other suppliers is 450. So we're going to take 250 out of that 700 and we're going to reveal an external liability of 450. But there's a little bit of a trick here. Now, the truth of the matter is the Forex exchange difference remains in current liabilities. That's true. But I do apologise, I've read the wrong line there. Paragraph 5. The subsidiary has recorded the liability and non-current liabilities at the rate ruling at the year start. That's true, but of course what they should have done is they should actually have recorded a loss. Now they have actually made a loss on this. Can you see the loss? Let's work it through. Now, what they actually owe is $50 million. This is what the sub owes to the parent, right? Sub owes to the parent $50 million. But what it originally recorded was a figure of, 50 multiplied by 5 is 250. But if you look at the year end, what it still owes is 50. But that's going to feel like 8 times 50 because the exchange rate has moved to 8. Don't know why I'm using my calculator, because we know it's 400, don't we? But, let's do it anyway. 50 times by 8 is 400. So the liability feels like we actually owe 400 now. So so there's an unrecorded loss in the subsidiary of the difference between 400 and 250, which is 150. So there's 2 losses in the subsidiary, one of which is recorded but in the wrong place, and the other of which is completely unrecorded. So paragraph 4, there's a loss of 15. That's recorded, but it's in the wrong place. And we're going to move it into the income statement. The loss in paragraph 5 is 150, and that's not recorded at all. So 15 plus 150, the combined loss that the subsidiary has made on Forex is 165. Now go and have a look on the income statement and see if it's in there in financing. And of course it isn't in there. The point is it hasn't been recorded in the income statement. It should be in the income statement, but it's not. And that's the problem. Okay? So what are we going to do in summary as regards paragraph 5? We're going to go... Okay? We're going to strip 50 out of the assets. We're going to strip 250 out of the liabilities. And we're going to throw 150 into the Forex loss. Okay? So we're going to go... So we're going to strip 50 out of the assets, 250 out of the liabilities because they shouldn't be there, and we're going to put in a loss of 150 that hasn't been recorded because it should be there. Paragraph 5, tricky. Paragraph 6 has then got the rates, and then we're back to paragraph, or should I say the requirement A. How are we getting on for time? It takes forever to go through that, doesn't it? So that leaves me with just enough time, I imagine, to bash through the answer at high speed. So here we go, here's my answer. Now don't be frightened of working this video a couple of times just to make sure you get all the information that's hidden in there, because there's a lot going on in this question. Like all exam questions, there's a lot of action. So it's exam question Xenon. And we start with the net assets, as we always do. We want to know how big the net assets are at acquisition, as at the start of the year, and as at the year end. We do that doing the equity method, starting with the share capital, which hasn't changed. The share capital in the sub is now 100, and that's what it would have been 12 months ago. And share premium won't have changed either. The reserves, as at the year end, are 2,000. And as at acquisition, we would get from the accumulated profits brought forward on the first page of the question a figure of 1,200. Now obviously we know that 1,200 needs adjustment because of the PPA that was in the wrong place. So paragraph 2, I believe it is, tells us that there's a PPA of 100, and had that been recorded, we would have had a correct reserve figure of 1,100. So I've combined the 1,200 and the 100 sausage to give me the 1,100 I should really have had at the start of my answer. Then paragraph 3 tells you there's a fair value adjustment on machines, I think it was, yeah, which are depreciating, and we're going to work that out as a balancing figure in just a minute, not straight away. I'm going to do this, I need a bit more space. I think I'll just bring it right down. And then we've got paragraph 4 and paragraph 5 for the two Forexes. Now it's tricky this, so you might need to work this a couple of times before you get used to it. They're very, very similar. One is a Forex loss of 15. Let's just get a bit more idea what's going on there in terms of columns. One is a Forex loss of 15 that was recorded but wasn't in the P&L report, and the other is a Forex loss of 150 that wasn't recorded at all. Now, the first Forex loss was a genuine, settled loss, because we took on a liability of $30 million and the rate was 6 at the time, But when we came back to pay the $30 million, we ended up paying at 6.5, so that's what gave us the figure of 15. 30 times 6 gives us 180. 30 times 6.5 gives us 195. 195 is bigger than 180 by 15, so we made a loss of 15. The other one's very similar, but the figures are bigger. It's 50 that was the liability, still is the liability actually, and this one is over a longer time span, so has a bigger effect with currencies. We originally experienced a rate of 5 and felt like we owed 250, but now at the year end we're experiencing a rate of 8 and we feel like we owe 400. 400 compared to 250, we've lost 150. But going back to the fair value adjustment on machines, I need this fella here, don't I? Now, given in paragraph 3 is the fair value of the entire net assets is 2 billion. So 2 billion is given in paragraph 3. Hopefully you can see that. And then what we do is I don't know if I can get this all on the screen at any one time, probably not quite. What we do is we add this to this to this to this to find out what's called the book value. So as you can see, we've got 100, 200, 1500, then 1400. So 1400 is the book value. 2000 is the fair value. The difference between 1400 and 2000 is 600, and that's the fair value adjustment. However, the fair value adjustment is itself depreciating. It is depreciating over a period of 5 years. 1/5 of 600 is 120. So we're going to deduct 120, and that leaves us with 480. Do you notice how little you write? It's really, really minimal, isn't it? You've got to keep yourself really, really punchy when you're doing these difficult exam questions. You can't be, wandering around and over-explaining yourself. You'll never get into the B section. So, this is a bit tricky for me to do all on one page, isn't it? But what the heck, I'll have to give it a go. So using the figures we're going to add down now. So 100 plus 200 plus 2000 plus 480 minus 15 minus 150 is 2615, which does sound familiar to me. You'll be pleased to hear. 2615, and you know what we're doing here. It's the usual thing. We're trying to establish growth, and the growth, as you can see, is 615. It's nice, isn't it? So nothing has changed from any other question you've done before. It's all the same stuff. It's just getting more complicated. Goodwill is the same as every other question you've done. This is full goodwill. This is full goodwill. So we've got the fair value of consideration, which represents 60% of the ownership. We've also got the fair value of the NCI, which represents 40% of the asset. And then we need the fair value of net assets. Whoa, itchy leg. We're no doubt going to need a working here. Once you get to complicated questions, you always end up with a working. The subsidiary is called G, isn't it? So only figures for G down the right. I've already got the fair value of the net assets, haven't I? That was that figure of 2 million that we've just utilised. The fair value of the consideration is a bit of a cheeky number. You might remember us doing this for the sake of completeness in the context of the previous question. What's that one called? Kenya. But now we're going to do it in anger. Do you see the investment in G is 440? Well, 440, of course, is the dollar version of what we actually spent. When I say we, I mean X. X didn't spend $440 million. It spent a number of crams when it bought G. And the rate would have been 5 at the time, so we multiply by 5. That gives us 2,200. 2,200 represents 60% of the equity, and if you take a look at the top of page, take a look at the top of the first page, just before the income statement, you'll see the NCI was 1466. So we've got 1466. And as you can see, rather cutely, it comes to 1666, which was the year of the Great Fire of London, actually, which is rather cute, isn't it? So that was the goodwill at acquisition, and it's still the goodwill now. I'm just going to check my watch, see how I'm doing for time. Not too bad. So obviously we can do the income statement first, or we can do the balance sheet first. It doesn't really matter which. As soon as I've got the goodwill, I tend to want to put it on the balance sheet, so I'm going to do the balance sheet next. I should put net assets, shouldn't I, on non-current assets. Starting with goodwill. Don't forget it's foreign stuff. So it needs divided by the year-end rate. Check out the rates at the bottom of the page in paragraph 6. So 1666 divided by 8, 208, I get. You know what it's like with these balance sheets, they often cause rounding errors when you've got foreign currency, so there could be one, I can't remember. Tangible. Remember the trick here. You're so keen to try and get the currency sorted, you forget the basics. Like, for example, FVAs. Watch out for the FVA. $480 left in the FVA. So what does that give us? 2280. 2280 divided by, what was the rate? 80, wasn't it? 8. 285 plus 3,000, 3285. Yeah, nice. Current assets. We've got a figure of 2,000 plus 2,200. And then we've got a couple of adjustments to put through. Difficult to remember, but first of all, the stock has a PUP of 3 because of paragraph 4. And then because of paragraph 5, do you see it says the parent has recorded the asset in current assets. So let's take out the current account because of paragraph 5. It's tricky remembering all this stuff, isn't it? Which is why it's really important you go fast in the exam. You can't remember everything if you slow down. You won't remember everything even if you slow down, but you'll definitely forget more if you're really, really slow. I was kind of demonstrating that point myself there by being a bit slow. It's rather cute, that, isn't it? 2-2-2-2. 4 little looks. Right. So now into current liabilities. $1,000 plus 1,000 plus 15. When we remove the Forex, the current liabilities reveals its true liability, which is 1015. So 1015 divided by 8 plus 1,000 is 1127. Non-current liabilities. This one's easier. 1200 plus 700. In paragraph 4, we're removing Forex. But in paragraph 5, we're removing a loan. Removing a liability from liabilities is much easier. And the figure of the loan, you might remember, was 250. So they have a figure of 700, 250 of which they owe to the parent, and therefore 450 is owed outside of the group. So that's 56. So that's 1256. I hate doing this because in the exam, you would never add down. You'd never add down in the exam because what's the point? It's not going to balance anyway, is it? But of course, I've got to add down just to check that, you know, I'm giving you the right information online, right? It's annoying because it's terribly bad exam technique. So it's 332. So in the exam, you add across but not down. You add across but not down. Share capital. Share premium. Reserves. And NCI. Let's do our NCI roll forward. So at acquisition, the NCI was a humongous 1466. The growth was 2615 minus 2, of which 40% is attributable to the NCI. And then that has to be divided by 8 because it's all in foreign stuff. So what am I doing here? 615 times 0.4 plus 1466. 1712 divided by 8, 214. Good. Okay, so I'm now going to do the reserves by the shortcut. Remember the working within a working. So parent, sub. The sub figures repeat the NCI figures, you might remember that. $46. Parent. $17.40. Very hard to remember this, but there's also a PUP, a parent PUP from paragraph 4. remember that? Tricky, eh? And then we've got the Forex. I've put minus on the Forex. I can't remember if it is a gain or a loss. Let's find out. So we have workings within workings now. So I'm going to add down there, get a total. So let's do the Forex now. So the Forex is measuring the investment in G, which was actually 2,200 at the year-end rate to see what it's worth now. And of course we know what they did at acquisition. They divided it by 5. At acquisition they got 440, and that's what it was worth. But what's the unrecorded loss? That's what we need to find out. So it does look like a loss, doesn't it? 2,200 divided by 8 is 275. Quite a big loss. Minus 440, 165. So there's an unrecorded parental loss on the investment in J of 165, and we're going to record that unrecorded loss. So 165 goes in there. $1,572. $1,618. So we've got 1,618. I'm going to slap that onto the balance sheet and keep my fingers crossed. $3,332. Amazing. It balances. What's the chances of that happening in the exam? Absolute zero. But I'm not going to get too cocky because it's time to do the income statement now. So fresh new brand new page, I would imagine. And let's do the income statement together. Okay, off we go. Revenue's 4,000 in the parent, 8,000 in the sub. The rate is an average of 7. But watch out, left hand selling to the right hand is 30. That's from paragraph 4. Watch out for that from paragraph 4. Adding across, we've got 4,000, 5,000. So 5,113. Okay. Cost of sales next. Cost of sales 2,500. $4,000. Going to divide that by 7. And then we've also got the left hand, right hand of 30 from paragraph 4, the internal transfer of 30. And we've got a couple of other things as well. Coming off the 30, we've got a parental pup of 3. And we've also got the FVA excess depreciation of 120. The pup, I keep repeating this, but as you know, the pup has come from paragraph 4. And the FVA excess depreciations come from paragraph 3. Yeah. Tough, eh? Welcome to P2. 17. We had a cross, but not down. Gross profit, forget it. Operating expenses now. See if you can remember the impairment. Yeah? Paragraph 2. Paragraph 2, am I right in saying that? Yep, paragraph 2. Operating profit, just in case there's an associate, look for an associate. If there's no associate, fine. I'm frightened of forgetting the Forex if I don't put it in now, so I'll put it in straight away. 2 Forexes. One a loss of 15, the other a loss of 150. One comes from paragraph 4, the other one from paragraph 5. Together they give 165. $23. Then you've got the 2 interest things. $43, so giving us 143. $14, so giving us 54. Watch out, that one is raw because it's income. Finally, tax. $300, 1,000 divided by 7, 143, 4, 4, 3. Whoops. And then who sits between Pat and Pam? NCI. Here it is, we're almost there now. You add down in the dollar column for the subsidiary. So you add down in the dollar column for the subsidiary right from the top. Just check my mic is working. Yep. And I'm going to highlight them for you as we work our way through. 1143, 571, 17, 157, 23, 43, positive 14 and 143. Just running out of tape, so let's hope there's time. 1143 minus 571 minus 17 minus 157 minus 23 minus 43 plus 14 minus 143 equals 203. You can see I've even rather cheekily got that in already there. 203 multiplied by 40% gives us 81. Fantastic. You've done it.